Hello everybody, and I welcome you to this session for CMA Final Strategic Financial Management. I just want to make it confirm that I hope I'm audible, I'm clearly audible to all of you. My video is there, my screen is shared properly. Is everything fine? You can reply in the question and answer window of this application and put your replies as a question. So if you're there, you can hear me, you can see me, and you can see my screen, then please reply. Okay, great. So let me ask you one more question here. And the question is this your first session for SFM in this season? Like in last 1 month, can I say this is your first session for SFM? Okay. My humble request to everybody is to not to remain anonymous, rather than just please put your name. There is a facility to change your name. If you see it properly, see, it will be difficult for me to communicate with you if you remain anonymous. So just simply change it to your name rather than remaining anonymous. Okay, let me ask you one question. When is your examination due? CMA final examination. Is it the June season exam you're going to appear, or is it the December turn you're going to appear? Please let me know that, so that accordingly I can make my strategies over here. And are you studying this subject for the first time? I'm going to teach you foreign exchange risk management. So are you studying this for the first time, or are you just making a revision and you have already gone through the entire syllabus? Please let me know. Okay, one reply is June 2021. Great. What do other people say? Another reply is also June 2021. One reply is this is first session. Okay. So many people have not replied. Based on the replies I already have in my hand, I can understand that you are going to have this attempt only June or July, whatever it is. And as far as SFM is concerned, this is kind of first session in last 1.5 months. There has not been any session on SFM. Very nice. Looks like there is a transmission delay of approximately 30 seconds to 1 minute. And that is why after speaking out a question, I'm getting your reply in 30 seconds to 60 seconds time. Great. Okay, I got it. So considering that you have this attempt only, you must have studied these concepts already. And what do you need is a very quick revision of the concept. That is what going to be fruitful for you. right? Great. So here I go now accordingly. So look, we are starting with a chapter titled as Foreign Exchange Risk Management. Now, this is one of the complex chapters of strategic financial management. It has least amount of formulas and huge amount of logics to be used over here. When you study portfolio management, a whole lot of formulas are there and a few logics are there only. When you study derivatives, some formulas are there, some logics are there, some procedure based study, some logic based study. But as far as foreign exchange risk management is concerned, it is sheer logic, nothing else. It is purely logic, doesn't talk anything else. So at times it becomes difficult for some people because they feel that if some kind of rule is there, if some kind of formula is there, life becomes simple, put the figures in the formula and get the answer. Okay, but this is not that kind of chapter. So let me tell you a quick background of behind the foreign exchange risk management. See what happened. Mother Nature created one planet Earth, but we humans, we drew political boundaries on this planet Earth. So I have drawn this boundary and this is called India. Somebody has drawn that boundary, they named it as America. Somebody drawn a boundary and they named it as Palestine. They named it as Israel. They named it as Gaza Patti. And they couldn't do the line properly and hence they are fighting a lot. The same thing is true with India also. So we drew line over planet Earth and we started calling that this is my land, don't enter here, or if you enter here, take my permission. That is your land, I will not go over there, and if I come over there, I take your permission. This is like drawing a line in a thali where you are eating food. So suppose your mom serves you a thali and at one corner of the thali you have chapati, at other corner of the thali you have rice, here you have dal, here you have some green vegetables, here you have some sweet, papad, chutney, achar, etc. And suppose 4 people are eating together in one thali and they draw line in this thali and they say this is my part of thali, that is your part of thali. Plate. So in that case, what will happen? I have only chapati, you have only rice, somebody has only dal and vegetable, somebody has only achar, papad, chutney, etc. Now that creates a lot of problem. We are not self-sufficient. Moral of the story, we are not self-sufficient. I have some natural resources, you have other. We need to deal with each other. Now here arises a problem. We don't deal in terms of barter system. That okay, you give us laptops and mobile phones and we will send you, rice and food grains and pulses and cashew nut and Alfonso mango. No. We don't do barter. Send us laptop, we'll give you Alfonso mango. No, we don't do it like that. What do is we give money. So if transaction happens, both buyer and seller are in India, there is no problem. I give you rupees and you accept rupees. But I import laptops, I import iPhones, and I want to make payment in terms of Indian rupees, they will not accept it. They want me to make payment in terms of dollar. I don't have dollars because my currency is rupees. So what do we need is a machine. We need a mechanism. We need a machine where if I insert one currency from one side, I get other currency from the other side. I insert rupee and I get dollar. I insert dollar, I get rupee. I insert euro to get Japanese yen. I insert Canadian dollar to get Swiss franc, and so on and so forth. So that machine actually exists, but it's not truly a machine, it's a mechanism. There is a group of currency dealers, banks, etc. You give them one currency and they offer you other currency. But when you give them 1 rupee, they don't give you $1. If you give them €1, they don't give you 1 rupee. If you give them $1 Australian, they don't give you $1 New Zealand, and so on. So what happens exactly is that you need to have, number one, what is foreign exchange? So I will say foreign exchange is the mechanism by which currency of one country is converted into currency of another country. It's a machine, it's a mechanism. Okay, this is one thing. Now the second thing is, how can I convert one currency into other currency? So I need an exchange rate. You know, if I go to the market and I say what is the, I won't say what is the exchange rate of this calculator. I'll go to the stationery shop and I'll ask him that what is the price of this calculator. I'll ask what is the price of this calculator. I won't ask what is the exchange rate of this calculator. But similarly, when I go to a foreign exchange dealer and I don't ask him what is the price of dollar, better I ask him what is the exchange rate for dollar. Why do they call it exchange rate? The reason is very simple, because when you take one currency, you don't give commodity, you offer them other currency. So you are exchanging currencies. And that's why the price or the rate of a currency is better named as the exchange rate. Now, a quick question arises. Is the exchange rate fixed? No, actually, there was a time, once upon a time, the exchange rate used to be fixed. They fixed, you know, that 1 ounce of gold is equal to so many dollars. 1 ounce of gold is equal to this much French franc, this much Italian lira, this much Indian rupees, this much British pound. Once upon a time, the rate of dollar was fixed for almost all currencies of the world. But thereafter, you know, they started realizing that the fixed rate system is not a good idea to have the international trade. So they changed it to the floating rate system, where the rate of the exchange will be decided by demand and supply of a currency. It's a free market. Like rate of gold is dependent on demand and supply of the gold. Rate of silver is dependent on demand and supply of the silver. Rate of, remdesivir injection, which is used to treat corona patients, is dependent on demand and supply. So the MRP was 800 rupees, but it was sold for 30,000, 20,000, 40,000, 50,000 rupees per injection, because the demand was huge and supply was very much limited. So it is all the game of demand and supply, my dear friends. So similarly, the rate of exchange is also dependent on demand and supply of a currency. But you know, saying that it is dependent on demand and supply is something vague. It's very broad something. You know, it is something like you go with your parents in a party and there you meet your friend and you introduce your parents like this. See, these people, they are my relatives. You tell your friend, pointing out at your parents, that these people are my relatives. Wow. So similarly, when I say that exchange rate is dependent on demand and supply, it is really very broad thing. I need to specify that eventually demand and supply are also dependent on some other things, right? So there are various things which affect the rate of exchange of a currency. So look here, what are the factors which affect the exchange rate? First of all, it is balance of payment. Now, what is balance of payment? This is just like receipt and payment account of the government in terms of foreign currency. So how many million or billion dollars received during a week? How many million or billion dollars paid during a week? What was the opening balance of foreign exchange reserve? Opening balance of forex reserve? plus receipts minus payment is equal to closing balance of forex reserve. This account is named as balance of payment. So if the balance of payment is favorable, that is the forex reserve in India increases. Suppose from 500 billion US dollars, it increases to 700 billion US dollars. So we will be kind of assured that, okay, we have huge amount of dollars in hand, supply is sufficient, so rate will remain in control. But on the other hand, if the foreign exchange reserve in India, say, reduces to $30 billion only, which is insufficient even to import oil, then in that case, it is short supply of dollar and the exchange rate of the dollar will increase very much. So balance of payment plays an important role in deciding the exchange rate. Second thing is inflation. So inflation is there everywhere in the world. Now, in some countries, the rate of inflation is high, and in other countries, the rate of interest is low. Let's take a situation. Suppose one basket of goods in USA cost you $1. You go to the market and you buy stuff, and this is the stuff, one basket of goods. Once upon a time in USA, suppose it was for $1. At the same point of time, suppose the same basket of goods, some food grain, milk, clothes, etc. The same basket of goods in India, the cost was 1 rupee. Now, basket of goods is equal to basket of goods. It is the same basket of goods. And therefore, $1 equal to 1 rupee. Imaginary situation I am taking that once upon a time, this was the situation. Let's assume. After many years, what happens that due to inflation, that basket of goods is available in USA for $10 due to inflation. The price has gone up to 10 times. Now, due to inflation, due to exorbitant inflation in India, the same basket of goods, which used to cost ₹1, is now costing ₹680. Huge. The basket of goods is still same. So what do I say? That $10 is equal to ₹680. Or I can say $1 is equal to ₹68. So this is how inflation affects. So once upon a time, $1 was 1 rupee, but thereafter at some other point of time, $1 became equal to ₹68. So if there is high inflation in domestic country, in that case, foreign currency appreciates. You know why? Because the home currency is depreciating. Then there is interest rate, which decides the exchange rate. So if the real rate of interest in India is high as compared to USA, then USA investor will prefer to invest their money in India. You know why? Because they are getting higher return over here. So they will pour money in India. And if they pour money in India, will have huge supply of dollar. And as far as the spot rate is concerned, dollar will become cheaper, right? So this is what exactly happened in year 1991. We were not having, sufficient foreign exchange reserve even to import oil. That would have resulted in stoppage of our economy. So then Dr. Manmohan Singh and other people decided that let's, gradually open our door for foreign investors, and we started opening our doors for foreign investors. And then we attracted a lot amount of foreign investment, foreign currency came in, our foreign exchange reserve became rich. If interest rate is higher in India, then initially I can say that dollar will become cheaper. National income. There are at least 10, 20, 30 factors which eventually affect the rate of exchange. So if suddenly national income increases in India, so that those who are poor, they become lower middle class people, those who are lower middle class, they become middle class, those who are middle class, they become upper middle class, those who are upper middle class, they start becoming rich, and rich started becoming super rich. If national income increases, if wealth of the people increase, then, they will start thinking beyond roti, kapda and makan. Besides feeding themselves, they'll start thinking of some luxury items. Let's have a big television. Let's try to have a two-wheeler. Let's try to buy a car. Let's try to have, some fancy stuff. So in that case, suppose they start consuming some good quality products, especially in India, those are not available. We import most of them, especially technology products. Like the laptops or the mobile phones you are using are mostly imported, or even if they are assembled in India, their parts are imported. So when national income rises, the demand for technology product will also rise. You will start importing more stuff. And if you start importing more stuff, then demand for the dollar will rise. And if demand rises, then the exchange rate for dollar should increase. This is the effect of national income on the rate of exchange. Then there may be hundreds of other factors. Resource discovery. Suppose in Rajasthan, somewhere in Barmer, we find an oil well. In fact, we find several hundreds of oil wells. And suddenly we realize that we are the richest, we have the highest storage of oil under our land, even higher than what the Gulf countries are having. So in that case, suddenly we will become rich, and the rest of the world will start asking oil from us also. In that case, the demand for the rupee will increase because they want to buy oil, they need to have rupee. If demand for rupee rises, then the rate of rupee will also rise and the rate of other currencies against rupee will fall. Resource discovery. Many other factors are constantly at play: psychological factors, speculative factor, investment opportunity, political stability, which play a very crucial role in deciding exchange rate. If I just talk on day-to-day basis, then even a heavy rainfall in Mumbai can cause the rate change of dollar. Due to heavy rainfall, if some of the foreign exchange offices could not open, in that case, some of the transaction could not be settled and the demand supply thing will mismatch and the rate may change by 1 or 2 paisa per dollar. So there are many factors at play which decides the exchange rate. One thing is very sure now, that this exchange rate is something which keeps on fluctuating. Now there are two ways to quote the exchange rate. One is the direct quote, another one is called indirect quote. These are not absolute terms, these are relative terms. So what is direct for me becomes indirect for you, and what is the indirect for me becomes direct for you. For example, what is direct quote? It is 1 unit of foreign currency. If exchange rate is expressed in terms of 1 unit of foreign currency for number of units of home currency, it is named as direct quote. Suppose I say that $1 equal to rupee 75. Now, obviously, all of us are sitting in India. I hope all attendees are also sitting in India. I am in India for sure. Let's assume you are also in India and you all are also Indians. But unfortunately, we are speaking and listening a foreign language. Though we are in India, but I'm not speaking Hindi or Marathi or Gujarati or Tamil or Telugu or Malayalam or Kannada, because that will become inconvenient for one or other people. So though we are in India and we all are Indians, and I say $1 equal to rupee 75. So in India, Indian rupee is the home currency and US dollar is the foreign currency. An exchange rate is expressed in terms of 1 unit of foreign currency for number of units of home currency. 1 unit of foreign currency for number of units of home currency. This is what we call a direct quote. What is indirect quote? That is 1 unit of home currency or number of units of foreign currency. So suppose I say that 1 rupee is equal to $0.0125. This is 1 unit of home currency, that is Indian rupee, for number of units of foreign currency. There is a relationship between direct and indirect quote. And direct and indirect code are like this. Indirect code is equal to 1 divided by the direct code. So, okay, come on, quickly answer one of my questions. Suppose I say that 1 pound is equal to rupees 80. Then convert this into indirect code and type your answer here. Waiting for your answer. If this is the direct code, then what is the indirect code? You need to tell me indirect code. Come on, type your answer. Right? And what if I say this is 95 rupees? In that case, it will become 1 divided by 95. Right? This is how it happens. Great. Now, just like you have direct and indirect code, there is one more way of expressing it. So the exchange rate may be expressed in American terms or it may be expressed in European term. So when I say American term, it means number of units of dollar for 1 unit of other currency. Like 1 pound equal to 1.35. So if exchange rate quotation is direct code for American people, I will say that it is in American term. And if the exchange rate code is indirect for American people, then I will say that this is the European code. Okay. If the exchange rate code is direct for Americans, it is named as American term. And if it is indirect for Americans, they name it as European term. So now, once you know that what is exchange rate and it is expressed either as a direct code or indirect code, the second question arises that how do I exchange rate? Okay, I know the exchange rate, but the question arises how to use the exchange rate. So I'll tell you about that. See, there is one simple rule about it, that how to use this exchange rate. Just a minute. Now I'll use little bit of Hindi also. Don't worry, I'll give you an English translation also. अगर exchange rate उस ही करेंसी की एक यूनिट में दिया है जिस करेंसी को कन्वर्ट करना है, तो हम एक्सचेंज रेट से मल्टीप्लाई करेंगे. What does it mean? It simply means that somebody say that okay, you have 2,300 euros, convert it into other currency, say Indian rupees or maybe Canadian dollars. Somebody gives you that you have 2,300 euro and convert it into Indian rupees. Now, if exchange rate is given for 1 euro, you will simply multiply that rate into 2,300. But if exchange rate is given in 1 unit of other currency, then you will divide with the rate. Simple rule is, first of all, check the given currency. Sir, I have several number of pounds. Okay, fine. If the rate is given for 1 pound, multiply by the rate, otherwise divide by the rate. Sir, I have 1,32,866 rupees. I want to convert it into another currency. Fine. You are given a lump of Indian rupees. If exchange rate is given in terms of 1 rupee, multiply with the rate. Otherwise, divide with the rate. If exchange rate is given in terms of 1 unit of the currency for which a lump sum amount is given, then you will multiply by the rate. Otherwise, you will divide by the rate. To support this, let's quickly solve one question. Okay, so as we decided that most of you are going to appear in this attempt only, so we don't have time to make questions and answer. I'll simply create quick examples and we will solve those examples. You are just listen carefully, keep ready your calculator, do calculation and quickly post your answers. Okay, I'll be waiting for your answers. You are required to convert let's say $10,600 into Indian rupees if $1 equal to rupees 70. See, in this case, what do? Given currency is dollar, yeah, and the rate is also given for $1, and that is why 10,600 should be multiplied by 70 to arrive at now rupees 7,42,000. Okay, if I change the question a little bit, and suppose now I say you are required to convert $10,600 into Indian rupees if rupee 1 is equal to $0.01333. Now the given currency is $10,600 while the rate is given for 1 rupee. If the rate would have been given for $1, I should have multiplied it. But it is given for 1 rupee and therefore I will simply divide by it. So just tell me how many rupees will it become? 10,600 divided by 0.01333. It will become rupees 7,95,199. Please cross check the same. Or suppose if I take both foreign currencies, you need to convert it into pounds. If 1 pound, this is a symbol for pound, is equal to dollar, let's say 1.1111. So come on. Solve this part of the question. $10,600 are there and you need to convert it into pounds. But the rate is not given for $1. Rather than the rate is given for 1 pound. Now that's the whole problem. If the rate is given for $1, I'll simply multiply by it. But if the rate is given for 1 unit of other currency, then I will divide by the rate. And I'll get an answer equal to maybe 9540. Just cross check it and tell me, is this answer correct? Fine, fantastic. So now you know how to use the exchange rate. If it is the 1 unit of same currency, multiply it. If it is a 1 unit of other currency, divide by it. This is a very simple concept, whether the exchange rate quotation is direct quote or indirect quote, whether you are sitting in your home country or you are sitting in the foreign country, whether dollars are given or pounds are given or rupees are given, rule is simple. If it is the quotation in 1 unit of the given currency, multiply it by it. If it is the quotation in terms of 1 unit of the other currency, then divide by this rate. Okay, fantastic. So you guys have answered it right. Except one answer which says 11,777. That answer is wrong because that fellow has actually multiplied by the rate while he should have divided, because the rate given here, if the rate is for dollar, you will multiply it by. But if the rate is for other currency, you should divide by that rate. Okay. Mr. Anonymous, please put your name. Now, let me tell you that whether it is the direct quote or it is indirect quote, exchange rate itself is of two types. One is the bid rate, another one is the ask rate. And then there is one interbank rate, and then there is one merchant rate. So let me tell you what is interbank rate and what is merchant rate. Interbank rate is like the wholesale rate, and merchant rate is like the retail rate. I said interbank rate is like the wholesale rate. So it is the rate at which two banks will deal with each other. Or for the convenience of understanding, I can say interbank rate is the rate at which just a minute. Interbank rate is the rate at which one bank will deal with the Reserve Bank of India. So they practically don't deal with RBI. They deal with other bank, but for the sake of ease, let's assume that the rate at which RBI deals with the bank is the interbank rate, and the rate at which bank deals with its customer, like importer or exporter, is actually the merchant rate. So you have two types of rate. One is the interbank rate and the other one is the merchant rate. Now, whether it is interbank rate or it is merchant rate, there are always two types of rate. One is the rate to buy, and another one is the rate to sell, which is actually named as the bid rate and the ask rate. So bid rate is the rate, to understand. Now you have four types of rates. One is interbank bid, other one is interbank ask. Then one is merchant bid, another one is merchant ask. Wholesale bid, wholesale ask, retail bid, retail ask. It is like this. BID, E for bid and B for buying. This is the way you can memorize it. B is the bid, is the buying rate, and ASK, ask. Here you find S, and S is for selling. So bid is the buying rate, ask is the selling rate. Ask rate is also named as the offer rate. So I can say interbank bid is the rate at which RBI is ready to buy foreign currency from banks. RBI here means the market. Okay. So rather than saying RBI, let's call it the market. But retailers are not allowed to enter this market. Only bankers themselves are allowed to enter into this market. So B for bid, B for buying, and ASK, ask, as for selling. Interbank bid is the rate at which market is ready to buy foreign currency from the bank. Interbank ask is the rate at which market is ready to sell foreign currency to the bank. So usually interbank rates are quoted up to 4 decimal points, and last 2 decimal points should be in multiple of 25. Just a second. Let me make it full screen. So that you can have a better visibility of my screen. Yeah. So I was telling you that interbank bid is the rate at which market is ready to buy foreign currency from the bank. And interbank ask is the rate at which market is ready to sell foreign currency to the bank. Now in India, all these foreign exchange dealers, that is the bankers, look, dealing in foreign exchange, anybody cannot do it. You need to have a license from Reserve Bank of India. Only then you can deal in foreign exchange. Otherwise, you are not allowed to deal in foreign exchange. Okay. So when you have a license from Reserve Bank of India, then you become a foreign exchange dealer. Now, all these dealers in India, mostly they are banks and financial institutions. All these dealers in India, they have created an association. And this association is actually named as Foreign Exchange Dealers Association of India, FIDI, Foreign Exchange Dealers Association of India, FIDI. So as per FIDI rules, what I can say is interbank rate is quoted up to 4 decimal points, where last 2 digits remain in multiple of 25. So in the 4 decimal points, last 2 digits will be either 00, or it will be 25, or it will be 50, or it will be 75. Now to understand all these rates, interbank bid and ask, merchant bid and ask, let's try to understand a concept of quote maker, QUOTE, quote. Let's understand the concept of quote maker and quote taker. So one who gives a quote is called quote maker, and one who asks for a quote is called the quote taker. You go to a shopping mall and you like a t-shirt which is there on a dummy, on a mannequin, and then you ask the shopkeeper that what is the price of this t-shirt, and then he will say this is for 1200 rupees. So look, the shopkeeper is the quote maker and you are the quote taker. If you like this quote, you can buy the t-shirt. Shopkeeper is ready to deal at this price. If you like this price, you can deal. Now that is how you can understand quote maker and quote taker, right? You don't go to a shop in the shopping mall and say, okay, come on, I am buying this t-shirt for 50 rupees. You can't do that. You are not the quote maker, you are the quote taker. So when there is a foreign exchange deal between the market, like you have Bombay Stock Exchange, a market, you have National Stock Exchange, a market. You don't have a market, you don't have a similar market for foreign currency as far as spot market is concerned. But for the sake of ease, let's assume there is such market. So when there is a deal between the market and the bank, market is quote maker and the dealer or the bank is the quote taker. And the rate at which they enters into a transaction is named as interbank rate. So in case of interbank rates, market is the quote maker and bank is the quote taker. But later when the bank deals with its customer like importer or exporter or foreign tourist or Indian student taking education abroad, when bank deals with its customers, this is the market, like a retail market. They enter into a deal with each other at the merchant rate. Now in this market, bank or foreign exchange dealer, it becomes the quote maker, and the importer or exporter becomes the quote taker. So moral of the story, in case of interbank rate, market is quote maker, dealer is quote taker. In case of merchant rate, dealer is quote maker and customer is quote taker, right? So what happens that the quote always remains favorable for a quote maker and it remains unfavorable for a quote taker. Like suppose this is the interbank bid. Look at my screen. This is the interbank, I have highlighted it. This is the interbank bid and interbank ask rate, 75 rupees and 76 rupees. And now let's say, so 75 rupees is the interbank bid rate and 76 rupees is the interbank ask rate. Now market is quote maker and dealer is the quote taker. So quote always remains favorable for a quote maker. Market says that we are ready to buy dollar at rupees 75 per dollar and we are ready to sell dollars at rupees 76 per dollar. So why am I calling it favorable for the market? They are ready to buy at a low rate and they are ready to sell at a high rate. They'll buy at 75, they'll sell at 76. If it is a single person who is buying as well as selling, then he'll make a profit of 1 rupee because he is the market, he is the market maker, right? So he buy at a lower rate and he sell at a higher rate. For the quote maker, that is the market, the rate is favorable. But if I look at the same quote from the point of view of quote taker, that is the bank. If the bank wants to deal in this market, bank can buy at 76. Bank can buy at rupees 76. You know why? Because bank can buy only if market is ready to sell. So whatever is the selling rate of the market becomes the buying rate of the bank. Bank can buy at 76, higher rate. Bank can easily sell at 75, lower rate. So for the quote taker, it becomes just the reverse. He can sell at the lower rate of 75. He can instantly buy at the higher rate of 76. So for quote taker, quote always remains unfavorable, while for quote maker, quote remains favorable. Okay. Now the same thing applies to the merchant rate also. Suppose the merchant rate here is 74.25 and 76.76. See, the interbank rate was, look here, just a minute. I will just give you a quick idea, a comprehensive idea. It's not a quick idea. See, students many a time get confused among various rates. If you have a good understanding of rates, then it will be easy to conquer rest of the chapter. So interbank rate is the rate at which transactions are entered into between the market, who is quote maker, and the bank or dealer, who is quote taker. Market is always ready to buy and sell. Therefore, dealer can sell or buy. Shopping mall is always ready to sell products. Therefore, you can always go and buy it. So market is ready to buy as well as sell. Therefore, you can sell as well as buy. Interbank bid and ask rate are 75, 76. Now, suppose the merchant bid and ask rates are 74.25 oblique 76.76. So if I look at these rates from the point of view of the dealer, he is the quote maker. He is ready to buy dollars at 74.25 and he is ready to sell dollars at 76.76. Therefore, the customer, like importer or exporter, can sell dollar at the lower rate of 74.25. You know why he can sell it? Because the dealer is ready to buy at this rate. On the other hand, the market is ready to sell it. The customer is ready to, customer can sell it at 74.25 while customer can buy it at 76.76. customer can buy it at 76.76. So guys, this is how it happens. Now there is so for the bank, the quote is favorable, buy at a low price, sell at a higher price. While for the customer, the quotes are unfavorable, sell at a low rate and buy at a high rate. Now look here. There is a relationship between interbank rate and merchant rate. Look, interbank rate is the market driven rate. What do I mean by market driven rate? It is decided by the forces of demand and supply. But merchant rate is a calculated rate. It is not decided independently in the market. Rather than it is calculated with a mathematical formula. And that formula looks like this. Let me tell you the formula. Okay, I type the formula for you. That's not a problem. Just a minute. So the formula is like this. If you want to calculate merchant bid rate, it is equal to interbank bid minus margin. So usually what do you understand that margin is added? See, margin is added when you are selling something. But if you are buying something, you would like to buy it at a low price. So in that case, margin will be actually deducted. How do you calculate merchant ask rate? So merchant ask rate is calculated by adding margin to interbank ask rate. This is your interbank ask rate, 76 rupees. Now suppose I add 1% margin. So this will become 76.76, isn't it? This is your interbank bid rate, 75 rupees. And suppose I deduct 1% margin. So practically 1% is very high margin. We are just understanding it for the sake of understanding it. So this becomes 74.25. Sir, why do we deduct margin? See, we are buying, so we'll buy at a low rate. And why do we add margin? See, we are selling, so we will sell at a higher rate. That is why this one is deducted, this one is added. Now look at the transaction, look at these transactions like this. That, say you are a bank, you are a foreign exchange dealer. And suppose your import customer approaches you and says, look, manager sir, I have imported goods worth $1 million and I have to make payment of $1 million. Can you sell me $1 million, please? And if yes, at what rate? Now, banks don't maintain stock of foreign exchange. It's not a supermarket where the things are stored and you go and it is available in the shelf. So banks don't maintain stock of dollar. The bank will immediately turn to the market and just like the customer, it will ask the market, okay, I want to buy $1 million. Are you ready to sell it? So market will reply, yes, buddy, we are ready to sell dollars at rupees 76 per dollar. Now, you see, the bank will say, okay, I am getting dollar from the market at the rate of 76. If I give this to the customer at the rate of 76, I'll make nothing. So I also need to earn profit. And that's why bank will say to the customer, look, I'll give you dollar at 76.76. So market will sell dollar to the dealer at 76. Dealer will sell dollar to the customer at 76.76. And this is how he'll make a margin. He'll make a profit of 76 paise. And that's what I was saying, that interbank ask plus margin gives you merchant ask. Now we just reverse it. Suppose an export customer approaches the bank and say, look, I have brought with me $1 million. Come on, take it and quote me the rate. Bank will say, wait a minute, buddy. Bank will make a phone call to the market. Okay, I have got $1 million. So will you buy it? Market will say, yeah, definitely. I will buy it at rupees 75 per dollar. You say, okay, you're buying at 75 per dollar. So then you will say to your customer, okay, look, buddy, I will buy at 74.25. Definitely, you need to buy it at a lower rate. Then only it will be profitable deal for you. So that's why margin is deducted over here. And this is the logic behind adding and deducting the margin. Right? Exactly. Yeah, you're right. 1% means 0.75. 1% of 75 is 0.75, and that's why the rate is 74.25. You're absolutely right. Okay, guys. So this is how. Now the difference between the bid rate and the ask rate is called spread. So here the spread is 1 rupee. Practically you don't see spread of 1 rupee. This is just for the sake of illustration. While here you see the spread of approximately, what should I say, 2.5 rupees, 74 and 76. Yeah. So in case of interbank rate, spread is 1 rupee. Difference between bid price and ask price is named as bid ask spread. So usually the bid ask spread of interbank rate remains low and bid ask spread of merchant rate remains high. Look here, this bid ask spread is 1 rupee while this bid ask spread is 2.5 rupees. Why this spread is high? Because in the lower rate you are deducting margin and in the higher rate you are adding margin. And therefore the gap rises and therefore the spread rises. In a deep market, in a healthy market, where many people are dealing at the same time, a market with huge volume is there, then spread will be very low because people will earn profit through volume. And that's why their margin will remain low. And that's why the spread will also remain low. So there are some points for spread. Spread can also be expressed as a percentage, like you do ask minus bid and then you divide it by the bid rate. You can simply say that bid ask spread is 1 rupee, or you can express it as a percentage of bid rate also. Okay. One more thing here. So traditionally, the bid rate is written on left hand side like 74.25 oblique 76.76. It is written on left hand side while the ask is written on the right hand side. And there is a good logic behind it that bid is always less than ask. You know why bid is less and the ask is more? Reason is quite simple, because bid is the rate at which quote maker is buying. And ask is the rate at which quote maker is selling. So that is why he will be ready to buy at a lower rate and ready to sell at a higher rate. So I hope you got this point, you got this concept. So time up for the day. Whenever we get a next schedule for this session, at that time I will carry it from this point and we will discuss further concepts of foreign exchange risk management. All right, guys. So just come prepared next time for Forex so that in the next session we can make a comparatively faster discussion and we can take it as a revision and not like a fresh batch. Considering the fact that you have this attempt only. Right? Okay then. Thank you. Bye-bye.